Warren Buffett and Cathie Wood have both made their investors extraordinarily wealthy. They have also, at various points, made their investors extraordinarily poor. And they represent two completely opposite views on where wealth is actually created in financial markets. Buffett believes wealth comes from owning businesses with proven, durable competitive advantages, businesses that generate predictable cash flows today, at prices that offer a margin of safety. Wood believes wealth comes from owning the technologies that will disrupt those businesses. Companies whose cash flows are minimal today but whose potential market opportunity is measured in trillions. Both positions have produced extraordinary returns. Both have also produced devastating losses. And the question of which framework is right, or whether both can coexist in an intelligent portfolio, is one of the most important questions any investor faces right now. In this video, I'm going to steelman both positions. No caricatures, no easy dismissals. The best version of each argument, followed by the evidence. Debate 3 is where it gets genuinely interesting because the answer is not what most people expect. Stay with me. Before we get into the debate, let me give both investors their full due because this conversation only works if we take both positions seriously. Warren Buffett needs little introduction on this channel. 60 years, $100 billion in personal wealth. The most successful long-term investment record in history. His framework, buying wonderful businesses at fair prices and holding them forever, has been documented, studied, and validated over 6 decades across every kind of market environment. Cathie Wood is a different kind of achievement. She founded ARK Invest in 2014 with a thesis that most of Wall Street dismissed. That the convergence of 5 major technology platforms, artificial intelligence, robotics, energy storage, DNA sequencing, and blockchain, would create multi-trillion-dollar markets and displace incumbent industries. In 2020, her flagship fund ARKK returned 157%. It was the best-performing U.S. equity fund of the year. Her assets under management grew from roughly $3 billion to over $60 billion in less than 2 years. Her conviction calls, Tesla, Zoom, Coinbase, Roku, became household names among retail investors. Then the tide turned. Rising interest rates crushed high-duration growth stocks. ARKK fell over 75% from its peak. Companies that had been priced for exponential futures saw those futures repriced violently. Many investors who had bought at the peak had their wealth approximately halved, then halved again. And yet, and this is important, several of her core investment theses are playing out exactly as she predicted. Artificial intelligence is transforming every industry. Electric vehicles are displacing internal combustion engines. DNA sequencing costs have fallen exactly along the curve she projected. She was right about the direction. The question was always the price. That tension between visionary accuracy and valuation discipline is the heart of this debate. Here are the 4 dimensions where Buffett and Wood fundamentally disagree. What creates value, disruption, or durability? Wood's case. The most valuable companies of the next decade do not yet exist in their final form. Technological disruption, AI, robotics, genomics, is compressing decades of change into years. The companies leading these platforms will capture value at a scale that makes today's incumbents look like typewriter manufacturers in 1990. Buying Coca-Cola in 2024 because it's a wonderful business is like buying Kodak in 1995 because it had great brand equity. The business is excellent, right up until the platform shift makes it irrelevant. The correct investment strategy is to identify the platform shifts early, by the leaders before the market understands the scale of the opportunity, and hold through the volatility that comes with being early. Buffett's case. Most disruption predictions are wrong. Or they're right about the technology and wrong about which companies capture the value. The internet was the most significant platform shift of the 20th century, and most of the companies that were supposed to dominate it no longer exist. Durable businesses with genuine competitive advantages are not easily disrupted. Coca-Cola has survived the rise of energy drinks, health trends, and dozens of direct competitors. Geico has survived the internet and direct-to-consumer competition. The brands, the distribution networks, the customer relationships, these are not easily replicated. And critically, a business that disrupts an industry is not automatically a good investment. The question is always price. If the disruption is already priced into the stock at 50 times revenue, early is just expensive. Evidence verdict. Both are partially right. Wood is correct that platform shifts create extraordinary value, and that many incumbent businesses will be disrupted. Buffett is correct that identifying which specific companies will capture that value is extraordinarily difficult, and that paying any price for disruption potential ignores the mathematics of valuation. The honest answer, diversification across both philosophies, with stricter valuation discipline on the disruptive end than Wood applies, is more defensible than choosing one framework exclusively. Debate 2 is about time horizon, and this is where the disagreement becomes genuinely mathematical. Time horizon 5 years versus 50 years. Wood's case. ARK's investment horizon is explicitly 5 years. Not because Wood is a short-term trader, but because she believes technological adoption curves move fast enough that a 5-year horizon captures the most significant value creation. Tesla was a 5-year thesis. Zoom was a 5-year thesis. The companies that will dominate AI, genomics, and robotics are ones where the inflection from early adoption to mass market happens within a 5-year window. Buffett's 50-year horizon works for businesses that won't change. It does not work for businesses that are defined by rapid technological change. Holding a position for decades in the technology sector means you will hold it through its period of relevance and well into its period of irrelevance. Buffett's case. The shorter your time horizon, the more dependent your returns are on market timing rather than business quality. A 5-year framework requires you to be right about both the company and the market's recognition of its value within that window. Most investors who attempt this are wrong about one or both. A longer time horizon allows the compounding of business economics to overwhelm the noise of market sentiment. It also removes the need to predict when the market will price in what you already know, because eventually it always does. The businesses that last 50 years and compound throughout are rare. But the returns they generate are so extraordinary that finding even one or two in a lifetime produces exceptional results. That is a better use of analytical effort than constantly searching for the next 5-year TH. Evidence verdict. This is the most mathematically resolvable of the 4 debates. The data strongly supports longer holding periods for most investors, not because technology doesn't create value, but because the average investor consistently underestimates how long it takes markets to price in disruption, and consistently overestimates their ability to time entry and exit within a 5-year window. Buffett wins this debate on evidence. But the caveat is important. His framework requires the ability to identify businesses with genuinely durable advantages, which is harder than it sounds. Debate 3 is the one I've been building to, because the answer reveals something about 2026 specifically that should directly influence how you're allocating capital right now. Valuation. Does price matter for transformative businesses? Wood's case, peak argument. Traditional valuation metrics, PE ratios, price-to-book, discounted cash flow, were designed for businesses with predictable linear earnings growth. They are systematically wrong when applied to businesses in the early stages of exponential adoption curves. Amazon was expensive by traditional metrics from 1997 to 2015. Every year, the DCF models said it was overvalued. Every year, the people who used those models missed one of the greatest wealth creation events in history. The correct way to value a platform company in the early stages of disruption is to model the total addressable market it could capture at scale, apply realistic margin assumptions at scale, and discount back. When you do that math for the companies ARK owns, the current prices often represent significant discounts to long-term intrinsic value. The problem with Buffett's valuation framework in 2026 is that it will never allow you to own the companies that will define the next 20 years, because those companies look expensive by every historical metric at the moment they are most worth owning. Buffett's case, peak counter. Every generation of investors has had a cohort of companies that were described as too important to value conventionally. In the late 1990s, it was internet companies. The argument was that traditional valuation didn't apply because the opportunity was too large and too certain. Trillions of dollars of investor wealth were destroyed when that argument proved wrong about the price, if not about the direction. The math of valuation does not change because the technology is exciting. $1 of earnings in 2040 is worth less than $1 of earnings today, and the further you project, the more sensitive the valuation is to assumptions about growth rates, margins, and competitive dynamics that are genuinely unknowable. Wood's total addressable market models for 2030 require assumptions about market share, regulatory environments, competitive responses, and technological execution that no analyst can reliably make. The models look precise. The inputs are speculative. Garbage in, garbage out at any multiple of revenue. The reason Buffett requires a margin of safety is not because he's unimaginative. It's because he knows his models are imperfect, and imperfect models applied without a safety margin produce catastrophic outcomes when reality diverges from assumption. Evidence verdict, the 2026 implication. This is the most consequential debate, and the evidence points in a specific direction for 2026. Wood is right that transformative businesses can sustain premium valuations for extended periods if their growth justifies it. Amazon proved this. But the evidence also shows that the premium required a very specific condition. The growth had to continuously exceed even the elevated expectations embedded in the price. When it didn't, even briefly, the valuation compression was severe. In 2026, with interest rates still elevated, the duration risk embedded in long-dated growth stocks is at its highest in 15 years. When rates are high, the present value of future cash flows, even large ones, is dramatically lower than when rates are low. This is the specific 2026 context that favors Buffett's framework. Not because technology is not transformative, it clearly is, but because the valuation math of owning businesses that earn predictable cash flows today is more favorable relative to owning businesses whose value is concentrated in a distant future when rates are elevated. The framework matters less than the conditions. Right now, the conditions favor Buffett. Debate 4 is the final one, and it's the most personal, because it's really about what kind of investor you are, not what framework is objectively correct. Psychology, can you hold through the volatility? Wood's case, the investors who held Amazon through its 2000 crash when it fell 90%, and then through its 2008 crash when it fell 60% made extraordinary returns. The volatility was real. The permanent loss was not. High-conviction investing in transformative technology requires the willingness to hold through drawdowns that would be career-ending for institutional investors and psychologically devastating for most retail investors. If you do not have that conviction, developed through deep research into the underlying technology and business model, you should not own these stocks. Wood's argument is not that ARKK is appropriate for everyone. It is that for investors who have done the research, understand the thesis, and have the psychological fortitude to hold through volatility, the expected returns justify the risk. Buffett's case. The problem with Wood's psychological argument is survivorship bias. The investors who held Amazon through 2000 look brilliant in retrospect. But in 2000, Amazon looked identical to dozens of other internet companies that also fell 90% and never recovered. The psychological capacity to hold through a 90% drawdown in a specific company requires a level of conviction in the outcome that is almost never justified by the available evidence at the time. Most people who held Amazon through 2000 were holding on hope, not analysis. They got lucky. The ones who held Pets.com with the same conviction lost everything. Buffett's framework, owning businesses with proven economics and durable moats, produces positions that are much easier to hold through downturns. Not because they don't fall in crashes, they do, but because the investor can anchor to current earnings, current cash flow, current competitive position, and answer the question, has the business permanently deteriorated? With much greater confidence than they can for a company whose value is concentrated in an uncertain future. Evidence verdict. This debate has a clear winner based on evidence about investor behavior. The vast majority of investors who own high-volatility growth stocks do not hold through the full drawdown. They buy near the peak, sell near the bottom, and crystallize the loss that Wood's framework requires them to absorb. The theoretical returns of Wood's framework are real. The actual returns of most investors who attempt it are not, because the psychological requirements are higher than most people can meet in practice. Buffett's framework produces lower theoretical maximum returns, but it produces more consistent actual returns, because the psychological demands are manageable for a wider range of investors. For debates, 2 frameworks, 1 question that matters. Let's be honest about what the evidence actually says. Cathie Wood is right that transformative technology creates extraordinary wealth. The companies that lead platform shifts, from automobiles to the internet to smartphones, have produced the greatest investment returns in history. Her identification of AI, robotics, and genomics as the next platform shifts appears increasingly correct. Warren Buffett is right that valuation discipline matters regardless of the quality of the business or the size of the opportunity. The history of investing is littered with investors who were right about the technology and wrong about the price. Who is right in 2026 specifically? Buffett's framework is more defensible right now, not because technology is less important, but because the valuation math in an elevated interest rate environment systematically favors businesses with cash flows today over businesses with cash flows in a distant future. When interest rates fall, which they will eventually, the relative advantage will shift back toward long-duration growth assets. At that point, a modest allocation to Wood's highest conviction theses becomes more mathematically attractive. The honest conclusion is not that one framework is universally correct. It is that both frameworks are correct in different conditions, and the intelligent investor uses the conditions of the moment to tilt their portfolio rather than committing permanently to either extreme. In 2026, more Buffett, some Wood. Not because Wood is wrong, but because the math currently favors patience and cash flow over optionality and duration. The next video in this series covers exactly what Buffett is doing right now given those conditions, his response to tariffs, trade war, and the specific investment moves he's making in a volatile 2026 market. That video is right here.